So let me reiterate: if you bought a stock for $1,000, you had to borrow $900 to pay for that stock, and all of a sudden that company began to perform poorly, and that stock was worth $100, and you decided I got to get rid of this thing before it is worth nothing, you would sell that stock for $100. You would still owe whoever you borrowed from $900. So if you buying on the margin is dangerous. It's a huge gamble if the stocks do not perform or increase in value. All right, moving on. We were also producing more things in this country than we could buy, things like radios and clothing and electronics, and this led to a surplus, which is a problem because if this huge line at the bottom of the page of people who are making radios, they can continue making radios, but if no one is buying the radios, then we can no longer afford to employ all these people. And if we lay some of these people off, that means there's less people making money, so not as many people buying things, and it is a cycle which we'll talk about in a minute. So the surplus is bad. Falling crop prices led to farmers losing their farms and losing money, not just small family farms, but huge corporate farms as well. And then the crash happened. The Dow Jones average is important because the Dow Jones average, if you take all the stocks sold in a day and average the price, some of them are sold for pennies, some of them are sold for hundreds of dollars. You take the average price of the stock, and that's your Dow Jones average. It goes up and down all through the day during buying and selling of stock. During Hoover's first year in office, the first day he took office, stocks were trading on average for $191 a share. By the time he left, it was $381. If you had invested money in the stock market, there's a great chance during Herbert Hoover's first year in office you made money. Moving on. Then Black Thursday happened, October 12th, 1928. Stock prices fell quickly. Some stocks began to perform poorly, and stockbrokers began to sell. And then when the sell started, it was a run happened. People began to sell more and more. GE started out that day, which is the largest company in America at that time, selling for $400 a share. By the end of the day, if you had stock in GE, you had lost money because the value of those stocks had fallen to $283 per share. Moving on. Now, that wasn't as bad as Black Tuesday, which is the day the stock market actually collapsed. On this day, October 29th, usually in a day, back then, in 1928, stocks sold between 4 and 8 million shares a day. On this day, when another run happened, a much larger run of people selling and selling and selling and selling stocks because they panicked. They saw that stocks were going down in price. They tried to get rid of all their stock. 16.4 million shares of stock are sold. 16,400,000 shares of stock are sold. The bottom fell out of the stock market. It collapsed. And to give you an idea of how much money was lost in this selling of stock, $30 billion of 1928 money was gone in one day when the stock market crashed. It led to people committing suicide. It led to businesses completely going bankrupt, investors and the rich losing all their money in a day. It was a huge deal. Moving on. And let me give you an idea of how sometimes these cycles work. For investors, it works like this. Investors lose millions of dollars, so they begin to sell their stocks. Businesses lose profit. So what happens when businesses lose profit? The stock value decreases, and investors lose money, so they sell their stock, which means the businesses lose profit, and it is a cycle that goes round and round and round. You need to write these cycles down with arrows or whatever. With a couple more cycles to go in the next part of this lecture.